All right, so here are some things that I do not want you to do in 2025. I'm going to go through this list one by one with examples using the screen that you see right in front of you. I do have a cheat sheet next to me just so that I stay on point and not ramble on, so that because I do want to keep this video short and sweet. All right, here's the first point. Do not buy funds that charge a front load, because funds that charge you front load is going to charge you the money regardless of the performance of the fund. In other words, let's look at an example. Right here, there are two funds. I just picked these two funds as examples. There are many other funds from JP Morgan and American Funds and a few other companies that do charge you a front load. For most people, it makes absolutely no sense unless you are an institutional investor, and when you're investing large sums of money, let's say over $1 million, they may waive this front load. For most of us, that is not the scenario. You will have to pay this fee upfront. What that means is, for every $100, $5.50 is going to be taken. In this example, some may be 5.75, some may be 3.5. It depends on the fund. Regardless, that's money that you have lost anyway. And the fund does not guarantee you returns that is going to compensate for the front load that they are taking. So what that means is, for you, you're not going to see that part of the money compounding. And every time you buy into it, that's the money that you pay up front. If you look at the expense ratio, so this is going to be the money that you're going to be paying the fund on a yearly basis that they charge you for the total amount that you already have put in there. So that expense ratio is 0.82 and 0.79. Although in the categorization it does say low, in my books, anything over 0.5, 0.6 is much on the higher side. Over 1, certainly on the higher side. If you look at the Fidelity Large Growth Index Fund, look at the expense ratio on that one. It's 0.03 compared to 0.79. And it has no front load at all. As a matter of fact, it's a no load fund. So right off the bat, you can see that on a yearly basis, you're going to be paying far less if you invest in this index fund versus the other fund. Now let's look at the performance. You may say that, what if the performance of the other fund is significantly better? Let's look at the performance. If you look at a 3-year return, I'm not going to go through every single column that I have here. You can probably pause the video and check it out, or even go to the Morningstar site and compare it yourself. Just look at this. If you look the performance here, the 3-year return on the large growth is 9.65. The index fund is returning 17.68 right here. And there's another index fund from the JP Morgan is returning 17.39. The Schwab index fund is returning 16.66. Just think about it. There's literally no comparison. So for most normal folks, do not buy into front-loaded funds. And there are other funds that charge you a deferred load, which means you pay the money when you sell the fund. That's just as bad. But I'm just using the front-load fund as an example. So stick with no-load funds. The second thing that I want you to keep in mind is stick with funds that do not charge you a transaction fee every time you buy into a fund. They are called non-transaction fee funds. They are categorized as NTF. NTF funds are funds that will not charge you a transaction fee every time you buy into it. Many of the other funds, a lot of the other funds charge sometimes $50, $25, $75 every time you buy a bunch of shares of the mutual fund. So I would just say that stick with no load, no transaction fee fund. Again, I'm always going back to the index fund. It is really, really hard, guys, to beat the index funds. There's a reason why Warren Buffett won the bet that he made with some hedge fund managers, where he challenged them to beat the index and they couldn't. And so Warren Buffett won. It's very difficult to beat an index fund in the long term. You may probably see a handful of examples here and there, but that's just few and far in between. So that's like looking for a needle in a haystack. Why break your head when you can use proven index fund strategy whereby you can invest without worrying about it, right? So that's those are my first 2 points that I wanted to cover. Also to keep in mind is there are some S&P 500 funds from Fidelity I'm sure probably Schwab may also offer them. They charge absolutely no fee at all. You can buy into some of the S&P 500 Fidelity funds with zero fees. In other words, you pay absolutely nothing for the passive investment funds and still reap all the returns and the rewards that you get from those funds. You can check some of those for yourself. If you're interested, let me know. Maybe I'll cover some of those specific funds in my next video. Another category of funds that I do not want you to specifically buy into in brokerage account, that is taxable brokerage accounts, is funds with very high turnover ratio. What that means is turnover ratio refers to how often the fund buys and sells stock within the fund. So the larger the turnover ratio, the more capital gains tax that it is going to generate for you. And that is not going to be good for you in taxable accounts, because every time it generates short-term or long-term capital gains tax, you will have to pay tax on it. What does that mean? Capital gains tax today, depending on your income level, could be anywhere from 5 to 15 to 20%, depending on your income. So that's a lot of money to pay in tax. What that in turn does is it eats straight into your compounding. The more capital gains tax you pay, the less money you have to compound. You can reap the benefits in short term if you have any emergency needs or something, but I'm talking about long-term investing here. It's a really bad idea. In a tax deferred account like your IRA, Roth IRA, 401k, it doesn't matter because you do not pay any tax within those accounts. You only pay tax at the income level when you take the money out of those accounts. So in Roth IRA, you don't pay any tax at all, period. But that's a topic for a different discussion. But by and large, I'm referring to turnover ratio. So let's see if I have anything here that talks about the turnover ratio. Yes, right here. So these funds, they vary in turnover ratios. This one, for example, has got 65% turnover ratio. That means the managers, they just buy and sell quite often, in my view. So every 6 months, the portfolio is pretty much less than 6 months, the portfolio is completely rotated. So this is going to generate a large capital gains distribution if it is in a taxable portfolio. So avoid funds like this. For example, if you see 5%, that's a really low turnover ratio. For index funds, you can see that the turnover ratios in general are very low. Okay. Because they're kind of passively managed. They're not, looking into, churning over. Unless a company goes out of business, they go bankrupt, in which case they have to yank that specific fund. Rare, but happens. It happened in the case of Enron in 2008, 2009. What they have to do is they will have to literally sell all the shares of that fund and then buy some other fund as they come into the index. So those events are, again, few and far in between, so I wouldn't worry about it too much. Another reason why I stick with index funds. The other thing is when you buy into index funds, you already know or have a pretty good idea what you're getting because the strategy is pretty standard. So there is really no reason for you to buy and sell off of those mutual funds, which means if you are somebody who is concerned about a fund's performance on a regular basis, actively managed funds may not be your best bet because they it's sort of like, it's all a mental thing. When you see that the fund performance is not matching other funds' performance, you have a natural tendency to sell it. But when you're talking about indexing, you're it's a passively managed fund. You just buy into it and you're in it for the long term. So naturally, you avoid selling those funds and buying into it again, which means you won't generate a lot of capital gains tax. Another point that I want to cover is look for funds whereby the manager tenure is relatively on the higher side. So what does that mean? That means every fund, if it's a passively managed index fund, it probably doesn't matter that much because it's passively managed. They're not really actively managing anything unless there's some radical changes happening in the index itself as to what companies that they are adding and what companies that they are removing, which are really not radical things. For example, NVIDIA got added to Dow Jones and also S&P 500 recently. What that means is the moment that stock gets added to the funds, the funds that are dependent on these indexes or indices, I should say, they will have to naturally buy into that company, because that's what indexing is. They will have to buy every share of the company that is part of that index. Now, the number of shares that they typically allot, that can vary, but you certainly need to have some representation of that stock in that index if your index fund is following that index. So for funds that are actively managed, if you're looking into it, you just want to make sure that the managers, it's not a revolving door for the managers. If the manager turnover ratio is very high, the manager tenure, it doesn't give the fund enough time to really implement the manager's strategy and vision, because things take time for the strategy and vision to take effect. So if there's a turnover every 2 years, it's terrible for the investor, because you really are not reaping the benefits of the knowledge of this and experience of that manager, because in 2 years you really can't implement any strategy that's truly short term. So I would say stay away from those kind of funds. If you look at the average manager tenure for these funds, you can see that it's pretty decent. Right of that, it just tells you the number of managers managing the fund. So here you have 1, some funds have 5, 2, 3. It kind of varies. What that means is if you have a large pool of stocks that is associated with a mutual fund, one manager cannot manage like 300 stocks. It's just not possible. So what they do is they divide and conquer. They specialize. So you have managers that typically look at, if it's a blended fund, some of them look at growth funds. Even in growth funds, some managers specialize in certain sectors. So some may be looking at energy, industrials, and cyclical funds. Some may be looking at financials. Another person will be looking predominantly at technology, because that is his area of expertise. Keep in mind that a lot of these managers, they're most likely coming from an analyst type of a background. In other words, they probably worked as an analyst for some other manager within the company or some other company, and they bring in that expertise. So if you're being predominantly an analyst specializing in technology, obviously you're a perfect candidate for, if you've worked your way up the ranks and become a manager, typically they'll give you assignments more related to the sector that you are most familiar with. So that's why you see fund managers dividing and conquering. But for the ones that are, if you just have one manager, that doesn't mean that that person is doing everything. It just means that he's doing the final, allocation and determination of the structure of the fund. But I bet the person has got tons of analysts, if not at least a handful of analysts working for that person. Why am I doing all this? Because the goal of the channel is to educate you so that you can make informed decision as to what funds best suits you and what doesn't. I learned this thing over my 30 years of investing, so I just want to pass that along to you, because it is hiring advisors and paying them 1 or 2% is not for me. Maybe it is for you. If it is, you just pay them the money and just wash your hands off. Then you're at somebody else's mercy, and you pretty much determine what they need to do. Typically, financial advisors are horrible investors, as Warren Buffett himself said, because they would take your money and invest in mutual funds, index funds themselves. But you could do that yourself. Why hire somebody else to do that for you? The next thing that I want to address is, if you don't have a buffer in your portfolio, I strongly suggest that you need to have a good buffer as a part of your portfolio. And when I talk about buffer, I'm not talking about funds that you use, if you have like some health care emergency or something to that extent, or some sudden home repair that you need money for, things of that nature. Buffer is essentially, stock market by nature, it's always up and down. It's never linear. Right? So even when you're doing the calculations, you should not pretend that it's a linear or some kind of a going up steadily kind of a thing. Although if you look at the last 100 years, it has gone up a little over 10%. But that doesn't mean that the market has not seen downturn, as most of you clearly have seen a few already. These things can happen. So that's why, in majority of the analysis, to determine how much money you would have at the end of 30 years or something, they do something known as the Monte Carlo simulation, and then determine where you're going to end up. So these are all simulations based on what's happened in the past. That's not to say that you may not see a scenario in the future that you haven't seen in the past. Very likely. We don't know what it is, but it's out there, and you most likely going to see it in some form. So be ready for it. That's why you need something called as a buffer. Why do you need a buffer? When you're saving for long term, what a buffer does is essentially it lets you not sell your funds to generate money in a severely down market. When you do that, you're essentially selling funds at a huge loss, and that's one of the worst things that you can do as an investor. Because the more you sell it as a loss, it's sort of like a inverse compounding, so to speak. You lose that money, and nobody wants to do that. So typically in the severely down market, you want to tap into your buffer and take money from the buffer, whereby buffer can be anything like a money market fund that is generating 4.5% interest rate these days. It can be fixed income securities that is fairly reliable and not truly fluctuating as wildly as stocks do. So I'm not talking about long-term investing. I'm talking about buffer that you can depend on. So let us say that you're hitting a severe snag in 2026, and you do not want to sell, and you need the money for your everyday living, especially if you're a retiree like myself. What you would do is you will depending on your expense. How much do you want to put in the buffer? That truly depends on your lifestyle. So if you have $250,000 in buffer, let us say, as an example, I'm not saying you should. What that means is if you need $150,000 to maintain your lifestyle, it covers more than that. Do you need that much? Maybe not. I'm just using that as an example. Maybe $150,000 buffer is enough for you to cover a whole year, which means if the market is down for a whole year, you're not really tapping into the market at all because you're tapping into the buffer. The buffer, you're going to slowly deplete the buffer if the market doesn't go up. That is true. So the size of the buffer depends on on your expenses, right? You also need to curtail some of the expenses if you need the buffer to last longer. On the other hand, how do you once the market starts to come back up, you need to replenish the buffer because you need that buffer. So so typically what you do is in a severely up type market, like for example in 2024, 2023, 23 and 24, I would have saved enough and added to that buffer because in an up market, it's fine for me to take some of that profit out and fatten up my buffer, so that when the market plummets, I don't need to sell it at a loss. I'll wait. It gives me plenty of time for the market to recover before I start depending on my savings. So buffer is vitally important. I can't give you an exact percentage of what the buffer should be, but that totally depends on your lifestyle. But I would highly consider, if you have not done that, you should have a buffer, completely different from emergency funds. All right, so I've covered that one, and let's see. The last point that I wanted to do is a basic advice from Warren Buffett. What he says is, do not invest in things you don't understand. This is one of the vital things that caused the 2008 and 2009 market crash. Companies investing in derivatives and other things. As much as I can analyze stocks, I figured out that for me, the path of least resistance is spend time identifying the best index funds to invest in and invest in them. I have bought and sold many non-index funds in my past, but my 30 years of experience tells me that there is really nothing to beat the index funds. It also alleviates a lot of pain in studying mutual funds in detail. I took a lot of pleasure, and it was fun for me to analyze all these things. So it really got me juiced up in getting into investing, which I knew nothing about 30 years ago. So in a way that is good, but my experience has clearly taught me that indexing is the way to go. And I would highly encourage you guys to look at index funds. And if you're not, please do. And Morningstar is a great tool for that. This is not a paid commercial by anybody by any means. This is a non-marketing channel. Everything I do here is intended as a benefit for the viewers like yourself. Keep it simple. My best advice to you is keep your investment simple but consistent. Do not stop investing, because compounding does work. It is real. Don't look at the market on a daily basis like watching grass grow. So anyway, on that note, I'm going to end this video. I wanted to keep it short, but I don't know how short this is. I will find out after I do some basic editing. Anyway, have a wonderful day, and I'll catch you in the next video. Bye-bye.